Next up is Thamage Lesito, a fixed income portfolio manager at Momentum Investments, who will be explaining to us how credit in our bond market is South Africa's challenge.
My name is Thamage Lesito. I'm a fixed income portfolio manager within Momentum Investments. Today I'll be taking you through the challenges that face the South African bond and credit markets. Before we can delve into the challenges that face the South African bond and credit markets, we need to first look at the dynamics at play in these markets. After the pioneering issue of the South African Breweries bond in the early 1990s, the South African credit market withered, wedged in by an avalanche of government paper on one side, low supply from corporates on the other side, and buy and hold investor attitudes in the middle. This phenomenon experienced in the early 90s is still at play in the South African bond and credit markets, even today. Challenges such as excess supply of government bonds, lack of corporate issuers, a buy and hold investor mentality, and lack of depth in the credit market still exist today. Also, as these two markets have matured over the years, so have new challenges emerged. However, as these challenges have emerged, these markets have found new and exciting ways of dealing with these. Throughout my presentation, I will highlight the challenges faced by the fixed income investor community in the bond and credit markets, some of the ways in which some of these challenges are being dealt with, and the new developments within the fixed income environment. The development and growth of the South African bond and credit markets has been led by government-issued bonds and government-guaranteed credits issued by the various state-owned entities. This has meant that the South African government is the largest issuer of fixed income assets. As the South African government debt has increased over the last 10 years, so has issuance of local currency bonds. With government debt sitting at over 60% of GDP, we now have over 20 billion of government bonds and treasury bills being issued weekly. Even with the increased issuance, we haven't had any failed auctions of either the bonds or the treasuries. With inflation expected to average 3.1% for the year and a 10-year government bond yield sitting at over 9%, it is clear to see that the South African bonds offer high real yields. The 10-year point alone is offering in excess of 6% real. Not many emerging markets offer this. We attribute this fact as one of the reasons why, despite the fiscal challenges that face South Africa, the South African government doesn't struggle to raise debt. Also, as my colleague Sisanda has mentioned, South African treasury bills offer a nice pickup over bank NCDs, and because of this, money markets continue to buy them. We have seen local bond issuances increase at each of the last 3 budget speeches. Widespread expectation was that at this year's medium-term budget policy statement, there would be some hint of reduction in issuance. However, this was not the case. With government debt expected to peak at 95% of GDP in 2025-2026, one can expect that the liquidity challenges that are brought onto the corporate credit market by government issuance to continue. As at the end of 2013, the JSE had roughly 1,600 listed debt instruments, totaling more than 1.8 trillion in outstanding nominal. In 2013, just over half of the debt listed on the JSE was placed by the South African government. As at the end of September 2020, South African government debt made up over 2/3 of the outstanding 3.5 trillion nominal listed on the JSE. This increase is solely as a result of the increased issuance by government. The South African credit market also has an active unlisted credit market. At present, the JSE has over 400 unlisted bonds issued by 67 different issuers. The nominal amount outstanding on these instruments amounts to roughly 350 billion. The South African unlisted credit market is also a buy and hold market. There's very little two-way flow that can be observed in this market. For investors to participate in the unlisted credit market, origination plays an important role, and this market is largely dominated by the big investors with large balance sheets, such as life insurers. End of September 2020, the JSE had over 1,800 listed debt instruments. Though the number of listed debt instruments has increased since 2013, we have not seen a significant increase in the number of corporate issuers. As at September 2020, we had 116 unique issuers. If one was to remove for the duplication caused by securitizations and bank listed SPVs, the JSE has just over 80 unique issuers. This is in a country that has over 300 listed companies across the various boards on the JSE. The lack of corporate issuers in South Africa has meant both in the listed and in the unlisted markets, creates a concentration risk for credit investors. Bond portfolios are heavily concentrated to the South African government, and credit portfolios are heavily concentrated to the large issuers. The South African corporate credit market is dominated by the big five banks, namely Absa, FirstRand, Investec, Nedbank, and Standard Bank. The top six SOEs, Airports Company of South Africa, the NAL, Eskom, the South African Roads Agency, and Transnet. Then there's the top three DFIs, the Industrial Development Corporation, Development Bank of South Africa, and the Land Bank. The limited number of issuers in the credit market and the excess government bond issuance do also mean that the South African credit market is not easily tradable. Two-way flow is hard to come by in the listed credit market. This is the primary reason driving the buy and hold investor mentality in the listed space. South Africa is a country that has an estimated savings pool of 7.6 trillion. As at the end of 2018, total pension fund assets had shrunk to $176 billion. This is down from 196 billion just the year before. This limited asset base needs to support equity markets, money markets, and the ever-increasing government bond issuance, the property market, and the credit market. With an already limited savings and investment pool, many of us fear that in an effort to bail out SOEs and contain the national deficit, the government may implement prescribed assets. If implemented, prescribed assets would force local pension fund investors to invest in government-prescribed investments such as SOE-issued credits. Though government has said it is not going to implement prescribed assets, as market participants and investors on behalf of our clients, we continue to be cognizant of this, and if introduced, it will have significant implications for us, especially in the credit market. Issuer concentration risks have meant that funds with mandates that need to be invested in the bond and credit asset classes have struggled with managing systematic risks. On the 23rd of April 2020, the Land Bank issued a SENS announcement advising its bondholders that it anticipated a possible default of debts falling due on the day. At the heart of the default was governance issues and a lack of leadership that have been with the Land Bank for the last 2 years. Momentum Investments' analysis of the Land Bank default led us to conclude that the lack of proper leadership and governance structures at the bank limited it to come to the debt capital markets and raise sufficient liquidity to cater for upcoming maturities, and thus forced the bank to go into default. The South African Treasury guarantees around 5.7 billion of the Land Bank's debt and has since granted the bank 3 billion rand of emergency equity funding. This default of the Land Bank not only puts pressure on local investors, but invariably puts pressure on the South African fiscus and on the local DFIs, who are also large holders of the Land Bank debt. This one default, if it were not remedied, could have wiped out significant amount across various money market, credit, and bond funds. Only 1 billion rand of term SOE paper was issued in the second quarter of 2020. Just two names, Eskom and Transnet, came to market tapping existing notes. In our view, the lack of SOE issuance cannot be solely ascribed to the closure of the debt capital markets due to COVID-19. The negative sentiment associated with the announcement by the Land Bank and the event of default that followed spilled into the other SOE names. We are now seeing fund managers taking more of a deep dive analysis before considering any investing with any of the SOEs. 2017, we saw a corporate failure in the form of Steinhoff. The Steinhoff failure created panic in the South African credit market. The lack of two-way flow meant that Steinhoff debt holders were stuck with the paper and at the mercy of the restructure. Luckily, the South African debt holders came out of this one unscathed. For me, the greatest two lessons to learn from the Steinhoff failure were that strong governance is not just about financial and regulatory compliance, and that even ethical business people are corruptible. As global markets crashed from 20 February 2020 to 7 April 2020, the South African bond and credit markets experienced severe pressure as doubles in these markets widened and liquidity came harder to come by daily. In March 2020, during the height of the COVID-19 liquidity crisis, when investors were forced sellers of credit assets, we saw spreads that were stale for many years on the JSE trade for the first time. Most of these credits traded at extremely wide spreads. Bank issued credit paper, which is more liquid than other credit paper, widened by as much as 100 basis points in the crisis. Had the market been one that had better price discovery, we could have seen these spreads tick up gradually as we led to the crisis. Most mature markets had this type of experience during this period. In the South African bond market, we saw bond yields sell off over 300 basis points during the crisis. On certain days, the liquidity would be completely dry, and if one was forced seller or a forced buyer of bonds, one could push the market in either direction. This, coupled with the Moody's downgrade and South Africa's exit from the FTSE World Government Bond Index, meant that we saw extremely volatile days during February and March. In September 2018, President Cyril Ramaphosa announced the Infrastructure Fund initiative that builds on efforts to transform public infrastructure development. The fund is meant to fundamentally transform the state's approach to the financing of infrastructure projects and reduce the current fragmentation of infrastructure spend, and thereby ensure more efficient and effective use of resources and improve the speed and quality of delivery of infrastructure. The South African government, post the Moody's downgrade and post the COVID-19 pandemic, has also come to the realization that it needs to act fast to get the South African economy back on track. After almost a decade of financial mismanagement, the government just doesn't have the funds. This constrained fiscal environment limits the availability of investment resources, and there is thus a greater need for government to work together and create an enabling environment for effective partnerships with the private sector, DFIs, international financiers, and the local capital markets. As government looks to crowd in both the local and foreign investors, they need to address the systematic challenges that have plagued the SOEs for the last few years. They also need to come to market with new debt instruments that will ensure that investors have direct access to the infrastructure projects. We believe that this will usher in an exciting period in the credit and bond markets. Our analysis is that, if done right, we could see the depth of the credit and bond markets improve as new debt instruments such as infrastructure and social impact bonds are introduced. We also think that this period will also be good as the government looks to put in better governance frameworks to ensure that investor interests are protected. In a world where ESG is increasingly becoming important, as highlighted by my colleague Ian Scott, the South African bond and credit market issuers need to get the big G right. We have seen governance failures in both the private and public sector that have had adverse effects on investors. However, as a market player in both the credit and bond markets, I'm comforted by the various efforts made to fix this. Of importance are the amendments to the JSE debt listing requirements that have been discussed with market participants for a number of years now. On the 31st of July this year, the JSE introduced two significant enhancements in the form of corporate governance with specific focus on state-owned entities and a disclosure and transparency requirement that will govern issuers in the debt market. It has taken 2 years to get this far, but together with ASISA and other market participants, we have worked hard into getting these enhancements introduced. An additional enhancement was announced on the 30th of September this year, the introduction of a debt officer. This officer will have continuing obligation to debt holders and will have the obligation of ensuring sufficient disclosure in both the interim report and the annual financial statements. Some issuers have nominated the CFO as the debt officer. This is encouraging as it shows that corporate issuers are taking this requirement seriously. To end off, I would say that governance issues that we have in the credit markets also need us as debt holders or debt investors to continually be meeting with the various management teams and ask the tough questions. We need to stay vigilant, and the moment we hear of a governance failure, we need to follow it up intently and not turn a blind eye to it. Thank you.